Let's take a look at the engagement view. This provides a central index for the full binder of the audit. It includes, for example, our lead sheets, knowledge coach forms, data analytics work papers, for example for risk assessment and journal entries, and of course our work papers. Let's begin with AUD 100, a knowledge coach form for our engagement level tailoring questions. As you answer each of the questions here, it will dynamically update the content throughout the tool. It's also integrated with the data that we've pulled in, so we can automatically complete the applicable areas for this audit based on where we've mapped our accounts. For those areas where we don't have mappings, the auditor can choose whether to scope in or scope out those sections. Also, this is where we decide whether we're going to test the operating effectiveness of controls for each area. So I'm going to say no, except for cash. And again, this will flow throughout the audit. Let's go back to our engagement view now and calculate materiality. So our materiality calculator is also fed by the data that we've imported. We can choose 1, 2 or more bases for the calculation. So let's say we want to use total revenue and total assets. And this is automatically pulled in that data from the imported trial balance, but we can enter those manually if you want to. Then we can define the percentages for overall materiality, performance materiality and our trivial amount. And it will automatically calculate what the result would be on those bases. Ultimately, the final choice of the chosen amount for each of these materiality measures is down to the judgment of the auditor, and we ask them to provide justification on the right hand side for the values that were chosen. We can also specify component materiality, perhaps for certain group companies or perhaps for certain areas of the audit, and we can define as many different components as we wish. These calculated materiality amounts will then flow throughout the tool. So next let's move on to our risk assessment. Going back to our engagement view, and you'll see we have an interactive work paper here for the risk assessment analytics. So the first step of each of the steps you see across the top here is to set some expectations. So based on our understanding of the entity, perhaps from our discussions with our clients or with our knowledge of the industry, we can document any expectations we have for the changes that we expect to see between the prior year and the current year. Here we don't see the current year balance, so we're seeing the prior year and we're encouraging the auditor to create a real expectation before they've seen the results for this year. So let's say, for example, we have an expectation for inventory and we want to break it down by section. The inventory is going to go up by a percentage and we're going to set that as a 10% increase. That will then calculate our expectation for the current year and we can document the rationale for why we chose that increase. We can set expectations for any audit area we wish. You don't have to set an expectation if you genuinely don't have one. You'll see on the left hand side here a breakdown of the balance sheet, the income statement, and also groupings by sales cycle and purchases cycle that shows each of the audit areas within them. You'll see here for inventory we have a warning flag, and we'll see what that means in a moment. Let's move into the ratio analysis. So here we're calculating various different standard ratios, and you'll have the ability to create your own ratios, industry specific or firm specific ratios as you please. So first of all, we've got the current ratio showing here. Often auditors can struggle to remember exactly what these ratios mean, so we have guidance throughout showing here what the current ratio is and how it's calculated. We show on the right hand side here in tabular form the actual ratio calculations for the prior years, and this is leveraging the data that we've pulled in from prior year binders. We've calculated a prediction for the current year based on the prior year data, and we've also pulled in the expectation that's based on the expectations that the auditor entered originally. We've also created a prediction for the next year in case that's useful for going concern. So I can see here, looking at the chart, that the actual result was below the prediction based on prior years and also below the auditor's expectation, but it is within benchmarks for the market. And the insights that show on the right hand side are bringing those out in words. We can see the same analysis for the quick ratio, and we'll calculate the same analysis for each of the different ratios supported. Next, I'm going to move on to the summary of insights. So like the insights that were pulled out for those ratio analyses, this is showing a summary of the insights identified for the inventory section, which I've selected here. We can either click on these to jump to the analysis that gave rise to these insights, or continue stepping through to see those insights in situ. So let's move on to visualizing and trending again for the inventory section. So at the top I have my balances, I have my expectation that we created originally, the difference to my expectation, and then we've got the difference to the prior year and the percentage difference. If we didn't set an expectation, then these columns would not be shown. We have a space for the auditor to provide comments to explain the differences seen, and also, again, we have the insights. So here we're picking out that the inventory balance is significantly higher than the expectation. This insight might be something that we wish to consider as we do our inherent risk assessment. So from here, if I click on this drop down here, I can choose either to dismiss the insight or create a risk indicator. If I create a risk indicator, it will turn red to show me that it's been flagged, and it will appear on the right hand side in my risk indicators panel as something that I've flagged. These will then be collated to help us with our inherent risk assessment. Down here we have our inventory overview, breaking down the balance for the current year and the prior 2 years that we have historical data for. And again, we've got some insights here. Let's show what happens if we dismiss that insight. You'll see it turns grey, and that won't be included in our later analysis. For each section, we can also check to show that we've seen the analysis and considered it, and that will update our progress on the left-hand side. So going further, we can see inventory trends showing the monthly change of inventory balance and a projection for the current year based on the prior year trends. This is useful to show things like seasonality. We've got a breakdown of the inventory by period for the current year and the prior 2 years into raw materials, work in progress and finished goods. And then at the bottom we're showing a box and whisker chart, and if you're not familiar with box and whisker charts, again we have some guidance here which explains what the plot is showing. But effectively this is showing the client organisation in context with other benchmarks in the industry. And we can see that the year-on-year change of the inventory balance is actually pretty close to the median for the market. So let's move on to the account flow analysis, again for inventory. What this is showing us is a breakdown of all of the transactions that have impacted inventory during the year. And this is really useful to help us understand the different flows of transactions that are taking place. So at the top we're showing first the debits to inventory. And we can see that the biggest combination to impact inventory with debits is debiting raw materials and crediting accounts payable. These are our normal purchases. You can see the annual impact and you can see the monthly trend, and that's pretty consistent throughout the year. The next biggest debit impact is debiting work in progress and crediting wage expense, and the insights are showing that this flow wasn't present in the prior year. We might need to consider that for the existence of inventory. And this might suggest that we've started capitalising labour costs in our work in progress this year, but we didn't in the prior year. However, you can see that the transactions are pretty localised on 2 months, April and September here, so we might want to investigate this further and generate a risk for this. Next up, we've got some net movements of 0, moving between work in progress and raw materials and finished goods and work in progress, and then our credits to inventory. This insight here is showing us that the account flows are inconsistent through the year, and you can see they disappear in the last few months of the year, so we might want to understand what's causing that. And then at the bottom we can see debits to inventory write-off account and credits to our inventory accounts. And again, this flow wasn't present in the prior year, so maybe we've done some significant inventory write-offs, and it looks like that happened in May and December of this year. So we might again want to consider a risk to cover these. Next, we can move on to understanding the different risk factors to inventory to help us tailor our inherent risk assessment. So on the left, we have some tailoring questions which will customize the risks that appear on the right-hand side. But I have a custom risk that I need to add based on my understanding of the entity. In this case, the client had a fire at one of its warehouses, so let's add a custom risk to account for that. We'll enter the risk description. And this is a risk that impacts the existence and the valuation of inventory. It's a significant risk and potentially a fraud risk as well. So that risk has now been added as a specific risk. And then we can use our tailoring questions to add in additional risk factors. So will reliance be placed on inventory counts at the period end? Yes, it will. And that will scope in risks based on those tailoring questions, which we can scope in or out of the audit. We can then continue to answer these questions, and we can choose which of those we want to consider as part of the audit, which risks are relevant. Then we can move on to our inherent risk assessment to pull these together. You can see at the top our specific risk about disposal of inventory. So we can make our current year assessment based on that. I'm going to set it as a maximum. And then for our assertion level risks, we can see our risk indicators that we stored as we went along the analysis, and the other risk factors that we identified with the orange flags. So let's set our current year risk assessment based on the things that we've seen, provide rationale, and then we can move into our Knowledge Coach risk assessment to finalise it. So now in Knowledge Coach, we're in the inventory section. Again, we have our specific risk. It's pulled in our inherent risk from the assessment that we just did, and I can complete my control risk, my risk of material misstatement, and our planned audit approach. For the other areas below, because we know that we're not testing operating effectiveness of controls, control risk has automatically been set to maximum. Combined with our inherent risk assessment, the risk of material misstatements automatically been calculated, and the planned approach has automatically been selected for us appropriately for that level of risk.